Today, financial services sector slashing some 49,000 jobs, partly due to a slowing mortgage business expected to be named the top job cutter for the month of October. Those are numbers that are in from Challenger Grain Christmas, the outplacement firm. But what is the risk to other job creators, and how will it affect your portfolio? Let's talk about that. Yu-Dee joins us, Ace investment strategist, the chief trader there. He's in Washington, D.C., where all the action seems to be lately. But what about these job cuts in the financial sector? What's the effect?
Yeah, Colin, we shouldn't be surprised at all. This is what's been happening over the past 4 years for most companies, and specifically for the financials over the past 2 years, right? So companies are growing earnings without growing revenue. So how do they do that? Well, they've been cutting back, getting mean and lean in this low growth, low yielding, and low revenue environment. I think we will see more of that going forward. That is cost cutting, thus higher earnings but lower revenue.
The idea of doing more with less, you're right, is not exclusive to financial services companies. And you look at some of the financials and how they're doing today. For the most part, they are higher in a market that is slightly lower. But you mentioned there's something that's key: a low yielding environment. This quote unquote search for yield. Everybody wants to find it. It's hard to find, certainly with rates staying as low as they have been, say, in the Treasury market. So where do you go now? What's your best bet at this stage?
Yeah, unfortunately, my best bet is what everybody else's best bet also, right? The equity market, whether it's U.S. or whether it's abroad, and that's where all the money is going to. Are we concerned with the potential inflation down the road? Maybe. Are we concerned with slowing down the economy? Maybe. Are we concerned with tapering of the QE3? Yes. However, for now, there's no place to go but the equity market, and that's what we're seeing. Are we going to get a pullback in the market? Maybe we will, but everyone is looking and watching and waiting to buy the pullback, and that's what we're seeing. So, Colin, this uptrend is intact. Every time it pulls back, we're buying it.
A lot of maybes, one yes, which I believe was for the quote-unquote tapering. So that you think that's the thing that finally slows down the stock market? And if so, when do we finally see it?
Yeah, that is my bet. If something were to slow down the market a little bit, it's going to be tapering. I think the earliest we will see it is in March. That's when Janet Yellen's first meeting will be. So that will be the earliest. I think most people now are expecting maybe tapering not until the second quarter of next year.
Right.
So we're still in this sweet spot, right? If the economy doesn't do well, then Fed is in there supporting the market. If the economy does do well, then companies are making money, good earnings, still higher stock market. So either way, down the road, market looks higher.
Best game in town is basically the argument. We've heard that from a lot of people. Maybe not today. We're pretty much flat down a few points, but always good to see you. Yu-Dee Chang, thanks a lot.
Thank you.
Airbus wants you